Good evening, everyone. I'm Suzanne Koster, and together with the Board of Directors of the Online Chapter, that's your chapter, welcome to our 5th annual membership meeting. We'll share what we've been up to this past year and our plans for the next year. As always, our standard disclaimer, information is presented for educational purposes only. Please always do your own research, and this session is being recorded. We're just going to wait for Joanne to share her screen. Bear with us for just a moment, everyone. We're having a little technical difficulty.
Okay, it says show, I can't click on my screen. It says main screen.
You want me to share my screen?
Okay.
I apologize, everyone. We're just going to wait to share a screen. And while we are doing that, maybe we can just chat a little bit about our portfolio contest. I think it's probably a great thing that our portfolio contest, it ended last week on Wednesday after today's tech wreck. I'm not sure anyone would have been exactly where they were. So here we are, and we're just about ready to get our screens shared. If you just bear with us 1 second. It has been quite the day here. I think even the big broadcast, the big banking houses today had a lot of trouble. So many people were in and out. A lot of people had trouble logging onto their broker today. So.
Can you see my screen?
Yes, thank you, Shriram. If you want to do view and just do slideshow, that'd be great.
Yes.
Perfect. Again, this is our 5th annual membership meeting. If you go forward one, Shriram, we can just talk about the disclaimer quick. Again, the session is being recorded. Anything that we present here today is for educational purposes only. Next. Our agenda for this evening will be very informative and educational. It'll include a chapter overview, our accomplishments for this year, our goals for next year, the election of our directors, and the results of the 2024 portfolio contest. Following our meeting at 8:30, join us for an engaging presentation from Craig Braemer on trim or sell, which one is better? Next. So let's begin with our chapter overview. Next. The online chapter of BetterInvesting is the largest, most diverse chapter in BetterInvesting. It has more than 3,000 members, more than 200 clubs, 2 online model clubs. Our chapter includes 35 states and territories, and we have 29 volunteers and 3 BIVAB directors. So, what has the online chapter accomplished this year? Our educational webinars are open forum, which are virtual on Zoom and live streamed on Facebook. These webinars are recorded and available on demand on our YouTube channel. We publish a monthly newsletter to all members and guests. One just came out today. We sponsor 2 model investment clubs, clubs that are open to the public to watch and open to members looking to join and contribute. We celebrate and support our clubs with anniversary certificate presentations and club visits. We sponsor a portfolio contest that is free to enter, and we are an active member of the consortium. It's a collaboration of chapters presenting interesting and informative educational topics. We have 51 clubs celebrating milestone anniversaries, including 10 newer clubs. So let's chat for a minute about club visits. If you move forward one slide, please, Shriram. This is a benefit available to all investment clubs at no cost by one of our volunteers. We celebrate and toast milestone anniversaries. We provide club training like club portfolio discussion, discovering stocks worth studying, SSG study tips, first cut tips for investment analysis, in-depth company research techniques, streamlining club operations, conducting effective meetings and engaging meetings, and an open Q&A on better investing practices. Next. Congratulations to the 13 clubs we've already had the privilege to visit. We look forward to visiting with the 5 clubs already scheduled for the rest of this year. Next, if your club is interested in a visit, you don't have to be having a milestone anniversary. Contact us, and you might be happy to have us come and talk about anything that your club can imagine in the better investing universe. Next. The current board has outlined several goals and initiatives for the next year. Our mission is to align with the better investing mission and provide support to members and clubs in areas not served by local on-the-ground chapters. Our goal is to engage and support our members and clubs, and we plan to achieve our goals through education programs, communication, video library, online model clubs, portfolio contests, visit to club, mentoring young clubs, club networking, and recruiting and training volunteers. We'd love to hear from you, our members and clubs, on how we can support you. In September, we'll be holding a planning workshop for the upcoming year, and all members are invited to attend, so watch your email for that invitation. And if you can attend, please contribute your suggestions in advance. And how will we achieve and support our goals for the next year? Well, with our volunteers. And a big thank you to the many active volunteers this past year. We need you to continue the success of our online chapter. If you're interested in volunteering, please download the handout. It contains our contact information and an application. We offer support and training to all our volunteers, and your commitment may be an hour to a month or more significant if you choose. If you have submitted an application in the last 1 or 2 months, we apologize. We've been sort of on summer vacation, but we will be getting to those in our September meeting when we address all of the volunteers that we currently have. So we'd like to open the floor to nominations from the chapter's membership to consider volunteering in the chapter. If you've already filled in an application, that's great. Please use the question box on your control panel to indicate that you'd like to be contacted and to find out more information about becoming a volunteer. It's now time for the election of our directors. The online chapter currently has 14 directors, each elected for a 3-year term. The terms are staggered, and about 1/3 of the director seats will be up for election each year. This year, we have 4 chapter seats and 1 BIVAB, the Better Investing Volunteer Advisory Board seat, up for election. Here are our current BIVAB directors. Bob Hoole's seat is up for election this year. The online chapter is unique. We are fortunate to include in our 14 directors 3 Better Investing Volunteer Advisory Board directors. These directors incubated the online chapter and continue to contribute to our success. Jane Chatterjee, Howard Johnson, and Bob Hoole. And this evening, Bob Hoole has been nominated to continue his role as a director for the online chapter. Chapter board members are unpaid volunteers with a passion for assisting and educating local clubs and individual members. Our current continuing directors are Avi Horwitz, Ernie Falzani, myself, Suzanne Koster, Jay Eagleson, Phil Sidori, Jack Finn, and Dan Perlman. We have 4 director seats up for election this year: Isla Barnes, Joanne Obata, Sriram Matabushi, and Chris McCarron. So now it's time for you to vote. It's the honor system, please. Only vote if you are a member of the online chapter. Chris, would you open the poll, please? And while Chris is opening the poll and you're voting, we'll just quick go back to our portfolio contest. I did tell you that after today's tech wreck, the values look completely different than they would have last Wednesday. I still think the standings would hold, but a lot of our virtual portfolios held a lot of tech, and tech really took the big hit today with the markets being down 2.5% to 3%. I think some tech was down 6 and 7%. Okay, Chris, would you announce the results of the poll, please?
It looks like we have 100% yeses. So the slate of directors passes as shown. And now I have to figure out how to close. Oh, there we go, close.
Thank you, everyone, for voting. Okay, and so now I'm going to give you the results of our chapter portfolio contest. It's a drum roll as we announce the second portfolio contest. So just as a review, everybody started with $100,000. Each entrant selected a minimum of 4 stocks or a maximum of 7. The contest ran from September 1st through the closing bell on July 31st. Entrants had one opportunity in February 2024 to make changes to the portfolio. Congratulations to our winner, the Let It Ride investors of Carson City, with an ending value on last July 31st of $140,000 or so. It was over 40% return in the last 11 months. And I will let you know that the Let It Ride investors of Carson City, won last year's contest as well, so they must be doing something right. And our runner-up is the Financial Escape Investment Club with an ending value of $129,000 and over 29% return over the last 11 months. So our new portfolio contest is coming up. Everybody is eligible to enter, either your club or an individual member. We would ask that if your club is entering, you don't enter as an individual member. Again, you'll get $100,000 of imaginary money. You get to choose 4 stocks up to 7 stocks. You can decide how those stocks are allocated in your $100,000. The contest will run from September 1st, 2024, again through the closing bell on July 31st, 2025. And again, in the February 2025, you will have one opportunity to make a change to your portfolio. Next. And so how can you enter? Here you can submit the online contest form, or you can just email us at contact@online.betterinvesting.net and put in the subject line portfolio contest. Again, the contest runs from September 1st, so we need your submissions by August 31st. So it's time to ask your clubs in your meeting in August, if that's your case, to get a portfolio together so you too can enter the contest. So here's a consolidated look at our chapter resources, our Facebook page, our YouTube channel, the website for volunteers, events, our monthly newsletter, and our video library, as well as our email contact. This information is also available on our handout. So next, we'd love to hear any comments and questions you may have. You can use the question box on your control panel to ask a question. And I'll ask, are there any questions out there now? Maybe Chris knows what they are. I do know one of the top questions that everybody has is about our model clubs and how do you join the model club. If you check the handout, there's a link on how to register for one of our 2 clubs. You can listen in at any time. You can hear what they're doing. You can see an investment club, how do they operate. Our model clubs are supposed to have best practices, and you get more information when you join the meeting. Another question that people have is, what if I want to join an investment club, but I don't want to start my own? Well, Better Investing started this called, what is an item called Club Connect. And so how do you use that as an individual or as a club? Well, Club Connect, Better Investing says, is sort of like investment club dating. It's a free service for members that matches clubs interested in adding new members with members looking to join an existing club. And once a match is made, clubs decide if they'd like to connect with a prospective member, and they reach out directly. The forms and information are on the Better Investing website. And again, that's called Club Connect. Another question that we often have is, what happens during a club visit by a volunteer? Some people thought that it's Better Investing spying on your club, but it couldn't be anything more further than the truth. The person that visits your club will be a volunteer, just like me or one of the other people on the board or one of our other great volunteers. And if we have a local volunteer, we might be able to send them in person, but most likely with our chapter, we do it virtually through our softwares, or we do it through yours. Each club has the flexibility to design the meeting that would fit their needs. It might just be a congratulations on your anniversary and a certificate presentation. It might be an educational session or a discussion on club's operation, or it might be sharing some of Better Investing's club benefits. Again, it's done by our volunteers. It's complimentary without any obligation, and it's free. It's free to you. Chris, did you have any other questions out there?
Yes, I do,
Okay.
Suzanne. So one question is, are the online clubs different from the BI chapters? What are the requirements for an online club?
And does that mean it's asking about our model club?
Well, I think there's just a little confusion about, we talk about online clubs, which are, so the online chapter are just, they could be, the clubs that are within the online chapter might be in-person clubs, or they might be online clubs, like virtual clubs that meet on Zoom or some other platform, but they're just within a region where we don't have another type of club, so they fall into the online chapter. Do you want to, I'm sure, Suzanne, you can do a better job of explaining that than I'm doing.
Sure. So there are two things. We are a chapter, and the chapter is just a geographic area in the United States. Like, for example, the Rocky Mountain chapter covers a lot of Colorado in the Midwest, and they are a real physical chapter. There are a bunch of chapters like the Rocky Mountain chapter that just happen to not be able to make it for a lot of different reasons. And so they decided that everybody needed to have a home where they could have a little more personal touch, and they formed the online chapter. So a chapter is different than a club. A club is, we're going to invest your money and we're going to talk about investment ideas, where the chapter is this administrative stuff that provides education and support from Better Investing. How about any other questions, Chris?
I'm not sure. I'm only able to see one question at a time. I'm sure I'm doing something wrong. But the next question is, you mentioned 29 clubs, and I don't know if that's a clarification of the previous question. Maybe we can invite the person to come off mute and explain.
I think that's Mel, right? Let me just see. We mentioned 29 clubs, right? So there's a difference. So the clubs that we're celebrating through our anniversary certificate, those are real functioning investment clubs. Like, I have an investment club, and Chris, and everybody has their own investment club. The chapter is the place where we come and get support for the Better Investing things that our club may use. For example, my club uses SSG and my iClub, and we use the Better Investing website and research. And if you need support with those kinds of things, that's what our chapter does. We also put out a newsletter, and we also provide some educational things. But the club, your club, would be where you're going to go and kind of pick those stocks and get invested in things. I know another question a lot of people have is, how do I become a volunteer and what's involved? And we did touch on it briefly in the earlier in the presentation, but there is a volunteer application in the handout, and we will train any of the volunteers that are looking for help. We'd ask if you have an idea about what you'd like to do. We have a lot of different categories, including visiting clubs. So if you feel happy visiting clubs, we do have a lot of clubs that have anniversaries. We offer the option for anybody that is having an anniversary to have a club visit, even if it's just a certificate presentation. You can imagine with 51 clubs, we could use a lot of people to help out with that. Okay, anything else out there, Chris, or?
Yes,
or-
a gentleman who had offered to be a volunteer. Actually, I just responded to his email before this meeting. He hadn't heard back from us and just wanted to make sure that we wanted to have more volunteers, which we obviously definitely do. So David, in the email I sent, I just wanted to know if you had a feel for what kind of volunteering you wanted to do. And that's a question for anyone who's thinking of volunteering. If there are parts of this whole operation that look interesting to you, then you could indicate in your questionnaire, in your response, or when you initially outreach to us about being a volunteer, you can let us know if there's something in particular that looks interesting to you.
Fabulous. Okay, well, we are at 8:26. Hopefully we will just take a minute or two to switch presenters, and we will turn you over to Craig, who I'm very interested to hear trim or sell. I'm thinking maybe if I sold everything last week, I might have been in a better position, but certainly we are in it for the long haul, and we will. So I'm going to now introduce Howard Johnson, who will be introducing our speaker for the evening. So Howard, I'll let you take it away.
Thanks, everybody, and welcome to our annual meeting tonight. Craig Braemer is a director with the San Francisco Bay Area chapter. He has been investing, we won't say how many years, but a long time. He's been a presenter at the National Conference for Better Investing, and he is also a certified financial advisor. He does presentations all over the country, and he's going to present tonight. He is very knowledgeable in the area of financial planning and financial advising, and I'm sure you're going to enjoy his presentation. So, Craig, we thank you for presenting tonight, and we'll turn the program over to you.
Great. Thank you, Howard. As soon as you send me ability to share my screen, I will share my screen. Show my screen. Here we go, guys. So can you see a heading page that says a quick review of trim or sale?
Yes, we can.
Fantastic. Okay. Just want to make sure it's all working. Thank you, Howard. Thank you, Online Chapter, for having me on today. As they said, my name is Craig Braemer. I am a financial professional, but I've been involved with better investing since the 90s. I started my first club in 87, second club in 90, and this third club in 94. And so I like investment clubs. I like investing, and so I do it professionally through the day, and at the rest of the time I'm doing teaching education. Anyways, bottom line is, if you have questions, feel free to ask throughout this class. This class was developed and came about a couple different ways, but I have found that people tend to find this to be an interesting topic, and it is a departure from how we normally think about it in Better Investing's world. So let me start off by saying something that some people might see as being outrageous, but I believe quality, when you think about a quality company, and we're going to get into that in a little bit later, what is a quality company? Quality beats out valuation over time. And if you believe that, then trimming is actually a very good way to go, because you keep holding what you think is a quality company for a very, very long time, but taking some of it off, profits off the table as you go along. Thus, this class departs from many of the standard Better Investing classes where valuation is key. I'm not saying you should throw away valuation. That's not what I'm saying. But I'm also saying don't be beholden only to to valuation and say, oh, it got to a price and sell, because I'll give you a couple examples later, and why trimming came about for us. So let's see here if I can get my slide. There we go. Disclaimer, I'm going to talk about a whole bunch of stocks. I'm going to talk about services. I'm not recommending anything. I'm just sharing this for educational purposes only, and this session could be being recorded. So this is my agenda. My email is at the bottom, so feel free to email if you like. What is trimming? I'm going to go through the concept of that, some reasons why selling is tough. And selling is, many people will tell you, selling is one of the hardest things to do. I have found trimming makes it a lot easier, because you don't go through some of the psychological issues by just getting rid of a little bit and letting the rest of it grow or go on for the future. We'll do a decision tree as to why sometimes you sell, sometimes you trim. And then do a little practice review, guidelines to trim a holding. And I believe I provided an Excel spreadsheet later. If someone wants it, you can, I think, be able to grab onto it and see it. If not, reach out to me. I'm happy to send it to you. And then you can see how I've used trimming over the decades. So with that, let's jump into it. So selling, trimming, or do nothing. Again, the chart there shows a stock that has done very well, and if I remember correctly, it could easily, I don't know what stock it is. It could be Apple, it could be anything. It doesn't really matter, but this is what these are the kinds of stocks we want to find, right? I mean, let's be clear. We're here to learn, but we're also here to make some money at the end of the day. So, but there are several risks you have with a winning stock. You could trim, like I'm suggesting tonight, if you have never trimmed a position. We'll get into discussion of that in a second. What does that actually mean? But if you trim, well, you could hurt yourself if you have a stock like this, because if you trimmed here, or even here, well, if you just waited to here, you would have made a lot more money. And that part is true. The real reason trimming came about was to control large position sizes and allow clubs and individuals to not get burdened by having a stock that does incredibly well. That's now a huge piece of the portfolio with huge capital gain. And this allows you to kind of control that over time. So one of the risks is if you trim, you could miss further upsides. However, the stock might not do that. Stocks do go back down again, as we learned today. Selling everything at any one point causes you to miss a lot of potential future gains. Maybe, or maybe that's where the price of the stock is and it could collapse from there. You don't know, because you don't know what the future is going to be. But selling at any point causes you now to get rid of that stock, and now what do you have to do? You have to go find another good stock, and if it's a really good company to start off with, getting rid of that and finding another good stock, there are risks with that as well. Then lastly, well, next to last, the biggest risk in my opinion is not owning this kind of great long-term stock. Our goal is to try to find as many of these as we can. We are blessed in Better Investing and investment clubs to have a portfolio of 20 or 30 names. If you were an institutional money fund manager, or mutual fund manager, I should say, or a ETF or something, you probably have 90 to 100 to 150 stocks in your portfolio. That's a lot of stocks you got to watch. We only own 20 or 30 stocks, probably at the most. Many clubs operate with 20 stocks or less. So we just need to find the best 20 stocks. So keep on working and keep on looking for those next 20, your best 20 that you can find. The last risk is do nothing and just hold on. You can do that. I'm not going to stop anyone from doing that, but there is a risk if it gets too big in your portfolio, and we will address that in a few minutes. So anyways, this is, to me, the reason why I have found trimming to be much better than just pure selling is I can hold something I already know that I think is going to continue to do okay in the future, because I think it's a good company that has all the metrics that I want to own, but it's just too big of a position in my portfolio right now. So that's kind of the background on selling or trimming. So in 1990, I started one of our clubs had a stock, and it did particularly well. I believe it was Disney, though I'm not 100% sure. And I think it doubled in a very short period of time. And it was like, we're a relatively young club, so we had large weights. So it was like 25% of the portfolio. And it then proceeded to have a bad quarter. Stock dropped literally in half over a period of time. And the bottom line, we said, maybe there's something better we can do here. And that's kind of where the whole thing came about. So there is the concept of, you want to maybe sell when things are rich. Maybe these are 2 good points, maybe, or, maybe buy things when they're cheap. So managing risk became our goal as a club from a position size perspective. And that's actually been a pretty straightforward process for us for the last 30, 40 years. And position size, I run into it very often doing club visits where a club will have 15 to 20 or more % weight in a particular stock. And that becomes an issue for them at some point in time, because either the stock might start to falter or they just have a very large position size and they don't really know how to handle it. Everyone is used to buying and selling, and not everyone's used to buying and let me get rid of a little bit, let me get rid of a little bit, let me get rid of a little bit. So let's be clear, stocks don't move in a straight line. The real goal of trimming is managing risk. That's the goal. I don't really have a big concern if the stock continues to go up and I gave up some of my return. That's fine, because again, my goal is managing risk, not maximizing return. So I have a big concern not only with gains, but also on position size. Then lastly, I throw this one word in here, and we're going to spend some more time on this later: wide moat stocks. If anyone reads Morningstar, they've really popularized wide moat or economic moat concept. Originally, this was heavily discussed by Warren Buffett, and then over time, this has been, Morningstar has really kind of made it their head of their process and research. I think economic moats are highly important, and I'll touch on that later. So if it's a wide moat stock, I treat that differently than other stocks, and we'll get into that detail later. So the concept of trimming is just really simple. Trimming is where you sell a small portion of your holding, you pick and choose what that portion is, and let the rest of the holding run. Now let's be clear. If you think there's a problem with the company, you probably just want to sell. But if you think there's just going through the run of the mill, hey, business was really great last year, this year's a little slower, but hey, this is a leader in their industry, they're continuing to grow very well, everyone loves their products, et cetera, et cetera, et cetera. Well, if you get rid of that company, then you have to replace it with something else. Well, you don't really know as much about that other company, probably, as much as you know of your existing company. And so become something that says, do you really want to just get rid of a really good company? And that's what we learned with another stock in our portfolio that we sold, and then watched it only go up 3 or 4 or 5 more times in value over the next 10 or 15 years because we didn't buy it back. And in hindsight, yes, we made a really good rate of return in a short period of time, but we probably would have made a better return in the long run by not having sold the whole position out. So we learned and said, let's try to think, is there a different way of doing this? I also find a lot of clubs don't spend as much time on their winners. I know that's the fact in my clubs, that we talk about our winners, but we really are spending most of our time on the stocks that aren't doing well. What's going on with them? How are they going to improve? What can we do to help them get better? Should we just get rid of these? Should we buy more of it, et cetera, et cetera, et cetera? Lastly, you can also automate the process for winners, and that's this Excel spreadsheet I mentioned earlier. Additionally, I have found trimming to be much easier discussion with people versus selling out of a whole position. There's less stress of, I'm selling out this whole thing. What happens if it goes up in the future, et cetera, et cetera, et cetera. I know none of you guys have ever had those concerns before. Oh, I'm going to sell the stock. What's going to happen? And then watch it go triple or quadruple after that. And you go, oh, I wish I hadn't sold that. I know no one in this world would ever have that problem, but I have had that several times. So it's a very simple concept, but when I first introduced this to Better Investing about, I think 5 to 10 years ago, I got the most response I've ever gotten from a national presentation. It seemed like I had cracked an egg, and someone had said, whoa, what is all this you're talking about? So I keep talking about it, and I keep on promoting this concept. So there's a lot of psychology issues with selling, and it can be from everyone. People don't want to admit that they made a mistake. Let's be clear. No one wants to say, well, I really screwed up on that one. But I will tell you, as a long-term investor, having done this for 40 years, get used to it. Get ready to say, yep, this one didn't work. Move on, move on, move on. And don't let it get into bother you in any way, shape, or form. Just get used to selling your losers to kind of, at the end of the day, keep your portfolio full of good, high quality companies that grow over time, and just keep on weeding out the ones that aren't working. I think that's probably what I've learned the best over my years of doing this. Many people fear of loss and fear of regret. To me, again, the regret is, yeah, we sold that stock only to watch it go up 4x in the next 10 years. I wish we didn't sell that. That would probably have been a good stock to keep on going. I hear this a lot, both from my clients, but also from some clubs out there. I don't hear as much from clubs, but I do hear it on occasion. I want to get out and get even. I don't understand that concept at all. It doesn't make any sense to me. I get you don't want to lose money. Got it. But at any point in time, when you're looking to sell a stock, it's based on what you think the future of the company is, not whether you're going to break even or not. The market does not care whether you make money or don't make money on that stock. Truly. I know some of us really believe that, the market saw I bought this on Friday, that's why it's down 4% today. Yeah, I fall into that trap all the time. I did buy something on Friday, and it did go down 4% today. But bottom line is the market has no idea whether you're able to gain or loss. And for you to get even doesn't really even matter at the end of the day. Lastly, there is no precise mathematical formula. And so I think it makes it tougher for people. And then what I've shared already several times, if you sell now, you might miss out on the future. And I've done that many a time where I've watched stocks go up, and I go, really wish I'd bought that one back, and just never did. And lastly, I guess, people lose money and people don't like that. So, but I will tell you, having done this for a long time now, get used to getting rid of your losers. Don't think twice about them. Move on. You can go back and look at them again some point later, at least 31 days later after the wash sale rules goes by. So there's a lot of issues with psychological issues out there. So this is a core decision tree for selling or trimming in my head. And so these first three buckets, if you have this long-term outlook for the company unfavorable, deteriorating corporate financial condition, time and original thesis isn't working, you probably should sell. If it's a cyclical company and you think it's had a big run and you think the cycle might be ending, you probably want to sell. However, there are times when I think there are things that go on out there. Profit margins for the companies deteriorated this year versus last year. Well, last year was a really good year. This year, just not quite as good. Is that really just temporary or long term? That's the tough question. You don't really know, and you really won't know until next year. But a lot of times, I have to trust, if I own a quality company, that they will work their way through those issues over time. So that's one thing. Bloated current asset balance sheet, i.e. the company has a huge excess inventories. A lot of the stuff happened after COVID. People ordered lots of stuff. The inventories got bloated. And then they had to try to slow down manufacturing. I've been trading a stock off and on called Trex that, again, not recommending it, not even on this deck. But, at one point it was a $40 stock. At another time it was a $100 stock. And all it was really was tied to inventories and perception of where the inventories were going. So to me, that's temporary. Companies can fix an inventory issue. You can't fix if your product isn't very good. And so quality of the balance sheet, do you not make enough money when you sell your products? That's an issue that you maybe or maybe not can't fix. Adverse management change. Again, to me, it could be a sell, it could be a trim. Depends on what you think of the management team. I have seen where Starbucks has done this 2 or 3 times now, where the existing management team kind of flounders. The prior CEO comes back to rescue the day on a shining horse, and the stock comes roaring back. So adverse management change, to me, again, if I think it's a great company, I'm probably going to ignore the management issue and go on with it. If I'm not sure about the company, I might just sell it and move on. But otherwise, I'll probably leave it in the trim category going forward. Increasing competition impacts profits. So that's when you can see on your section 2, your quality section, are the profits going down? And yes, if you can see that, that might be something that will cause you to sell it completely, because you have you're convinced that they have future problems that will be an issue. Or not, if you think it's just more of a temporary, they can work their way through this. Again, I depend very heavily on Morningstar and their wide moat analysis, and I'll explain to you why that's so important. Then lastly, if it's dependent on a single product, I'm not a big fan of single product companies, just because something can come along that can replace it. But that would be more in a sale candidate, but you could trim that if you think it's something that no one else has. So I'll give you an example of a company that's had a single product for 20 plus years, and there's only very little competition, if at all, out there, and that's Intuitive Surgical, ISRG. They are dependent on a single product. They do robotic surgery tools. That's it. Well, they sell the consumables as well, but that's their product. So the bottom line is, there I trim. Why? Because there's nobody else that really competes with them. If it's something else that others can do over time, well, I'd probably be more in the sale candidate. Then lastly, of my core decision tree is trimming. And the trimming really comes down to high valuation of quality stocks. So if it's a wide moat stock, I will almost always trim versus sell. Why? Because there's not that many of them. And I'll explain to that in a little bit later. Position size has become too large. That is a risk too. So I do want to trim those as well. So down here is where I tend to do most of my trimming. Here, it could be either one. Then up here, I'm just going to sell, move on. Admit my mistake and move on. So here's your risk of doing nothing with a big winner. You have a big stock that's done fantastic. It's now 15, 20% of your portfolio. And it happens to be GE or JCPenney or Lehman Brothers or WorldCom. And then all of a sudden out of nowhere, or it could be, last year's, I'm trying to think of the bank that went out. 2 banks went out, or if not more, but several banks just went out of business literally within about a week. And so having too big a position size is great when it's working, but if it doesn't work and you have a problem, it has a real big impact on your life and on your closed portfolio. Trimming helps control the size of big winning positions. It also raises cash for diversification and to get no other names. So if you sell it all, you have to find another company that you hopefully will be as good as the one you sold. So here's an example of a stock that if you had done nothing from here, back here in before 2000, and held all the way to the date down here, you would have made no money. You would have been in the stock for 20 some odd years and you made zero return. If you had trimmed because the stock had gone up a whole bunch and it was a big weight in your portfolio, well, maybe you would have trimmed at some point while the stock was up and then eventually went back down again. The problem is it's really hard to know the future. And that's the problem we all have in the stock market, is we don't know what the future looks like. Every day we go to work as an investor, we have 4 options. We can sell your shares, we can buy more, we can do nothing, or we can trim. So I wanted to walk through example. Typically in a class, I'd be surveying people's faces. I can't do that here. If you guys want to, you can go put it into a chat box and they can report out to me if they want. So the bottom line is, this is what a stock has gone from here to here over this period of time. What do you do now? Again, we don't know what the future is. It's easier to see a good stock looking backwards, and it's easier when I tell you the name of the company. Well, the question is, what would you do now? Would you buy? Would you sell? Would you do nothing? Or would you trim? Well, let's see what happens. It's Better Investing World. Check out your SSG, and you should. Well, in this case, the stock went up significantly from where it was. So now you're stuck with the same situation you had before. The stock's now gone up a lot since you bought it, and you're in the same situation. Do you buy more? Do you trim? Do you sell? Well, again, check out your SSG. In this particular case, oops, the arrow was off base, but but you can see it was right there. And then the stock went up significantly from there. And here's the last part was, this is where the chart was, and then it went up significantly from there. So the problem everyone has is it's easier to go look backwards and say, well, yeah, you should never have sold. Just hold on to the sucker. You would have made a ton of money. It's not as easy in real life as it is when you are going along and you don't know where the future is, because you think at some point, well, stock's had a great run. I should take some money off. I should sell the whole damn thing, go to something else. Well, it doesn't work really as easy as it looks in hindsight. And so that's why really trimming became really easy for us to do in our clubs. And in a live presentation, I would go through 3 or 4 or 5 slides doing the exact same thing, and people will get it wrong pretty consistently. And the whole message is, you don't know what the future is. That's really the simple message. So why trim versus sell? My firm belief is I want to own stocks forever. However, that's not a realistic goal. If they are continuing to execute, I probably will hold them for many years. I've held stocks for 20 and 30 years because they continue to execute, from my opinion. I tend to lean more towards trimming than selling. My goal is to reduce my risk by controlling large position sizes. Winners seem to continue to win due to their strong economic moat. There's that economic moat for Morningstar again. My 2 biggest factors are a solid stock selection guide and whether a stock has a wide economic moat. If they don't have a moat, yeah, I'm probably just going to sell. So I'm going to let the company, if the company if Morningstar says they don't have a moat, or a lot of smaller companies aren't even followed by Morningstar, if I don't think it has an economic moat, I'm just going to move on. I will take my money and go. So no moat companies have had historically poor performance. So, and we'll show that data in a few minutes. Here is the pictorial of why moats are important. You got wide moat and the big strong castle, a narrow moat with a castle, and then you got a no economic moat, just a little tiny castle. Well, in Better Investing's world, this thing called ROIC is what we are familiar with, which is called ROE, or return on equity. It's very similar. It's not exactly the same, but it's very similar. So in essence, the major issue between a wide moat company and a no moat company is the horizon, how long Morningstar thinks they can maintain its moat. If they think it's for a long time, that they can keep competitors out for a very long time, they expect it to last for 20 years. If it has no economic moat, that means it could disappear tomorrow. If I'm a retail store that has this great product that no one else has today, well, that might be great until someone else's store can get that same product, and then you don't have that advantage anymore. So you really don't have much of an economic moat out there at the end of the day. And a narrow moat looks at about a 10-year time horizon. But this is just a simple thing that you can maintain these very high profit margins for a much longer time horizon. Think Microsofts of the world, where they have a significant protection versus others out there and how they operate, et cetera, et cetera. Retail tends to be over here. Why? Because anyone can put a new store in place. And so restaurants tend to be also more on this side than this side. So that's just how the world kind of works. But this is a very simple pictorial, and I think it works for me to think about those companies. That I want the companies that have very good margins and that they can hold on to those margins for a very long time. I also think you can see this in your stock selection guide. Well, before we get there, this is probably the most important slide of the whole deck from my perspective. This is when I saw this document back in, I think it was 2018, I was shocked. This was real historical data, and it showed that there was a big difference between certain types of companies. So we're going to go to these arrows and column the yellow arrow going down. The universe we looked at, was Morningstar looked at, had an average return of about 7%. If you were a wide moat company, you did almost 2x that. If you were a narrow moat company, you did about 150% better than that. If you were a no moat company, you did less than half of that. That was eye-opening to me, and that said, I don't necessarily want to spend a lot of my time over here with no moat companies. Why? Because in the long run, a 10-year return, which I don't think is that long of a return, is not going to get me a great return. I'd rather spend my time over here and over here as a whole. And on top of that, oops, sorry, let me go back. And on top of that, these returns are lasted over a long time horizon. These were 10 years, and pretty consistently versus no moat, they outperformed every single time. And so it just became very clear to me, I want to spend my time with wide moat companies, partly because there's only 200 of them, and narrow moat companies over spending my time with no moat companies. So that was my thesis. So in constructing how I would then do a trim, I wanted to figure out, how do I do this on a mechanical process so I could just do it automatically, and that we didn't, so I could basically go to club meetings and say, okay, our system says it's time to trim. Let's discuss it. I came up with the knowledge after visiting several clubs about 7 years ago that said, what is too big of a position size? They asked me several times. I said, there is no right answer. But I said, mechanically, this is how I would think about it. And I just came up with the notion that 2x your average position size. So it doesn't matter if you have 10 stocks or 15 or 20 or 5, the math is all the same. It's 2x your largest size, 2x your average size, which in my head says a 2x of your average size is a pretty good size weight in your portfolio. You probably want to pay attention to it. So in this particular example, a 15 stock portfolio has about a 7% average weight. A 2x of that would mean that anything over 13.3% would be something that I would potentially want to trim. I don't have to trim. I just want to be aware that it's a big weight and that I might want to trim. This allows for the club to have a discussion. Do we want to do it? Do we not want to do it? I can tell you with one of my clubs most of my clubs have historically, the question is it's not whether we're going to do it or not. The question is how much we're going to trim. And that's usually so we're already pre-programmed into the conversation. We're going to sell something. We just don't know how much. So I then combine that with a second lever, and the second lever, after I know something's greater than 2x in the portfolio, is a gain portion. I came up with a number of 60%. It's a bit random. I didn't do a lot of historical analysis, other than I did look back at some history that said to me 60% seemed to be a pretty good time to be taking a gain if you can get it. You could use 80, you could use 100. Doesn't really matter, I don't believe. I picked 60. In Excel, I can put this in an easy formula in Excel, and so I can easily track our gains versus cost very simply and make a decision, should we trim or not? Again, valuation is not my primary reason to trim. Valuation almost doesn't even play a part here. But if you think about it, it does, because if a stock's done really well, its valuation is probably higher than a company that has not done terribly well. So there is some of that in there, but the bottom reason is we're trying to control our position sizes. I want to focus on solid stock selection guides with wide moats and hope to own those stocks forever. And in many cases, I've owned, even my most latest model, San Francisco Model Club, we have stocks that we bought in our first round. I believe we still have 1 or 2 of them that are still in the portfolio 11 years later. So the real question comes up is, how much do you want to trim? My clubs have picked numbers between 10 and 20%. It's enough of a trim to get some assets off the books, but it's not so big of a trim that if the stock does continue to do better, then you've missed out, you've taken too much away from that potential gain. So we've ended up with 10 and 20%. We've been generally happy with that over time. So make it big enough to reduce that weight, but but at least still leave enough of it to still grow down the long run. Long-term debate, great long-term potential, what you think the stock is versus taking some money off the table. Like I said, in most of my clubs now that use this, it's when the system automatically kicks it out as a name that should be trimmed, there's not the discussion, should we do it? It's how much should we take? So that's changes the discussion in the meetings. I have found that the clubs find it much easier to sell small amounts. There's less stress than selling out of a complete position size or a very large portion of a stock that's done really, really, really well, because everyone is afraid that if they sell this and then it continues to really do really, really well in the future, that they have missed out on a lot of future. So this also dovetails very well into strong economic moat companies or wide economic moat companies, because they tend to have an advantage structurally in their marketplace over time. As we saw earlier, it's very tough to identify where's the peak in the stock. I'm sure everyone last week could have told me on Wednesday that, ooh, Friday's going to be really horrible, and then next week, watch out, Monday's going to be really bad. Bitcoin is going to drop like 13%, and Japan is going to drop 13%, and we don't know what's going to happen next week. I've been doing this for 40 some odd years. I have no idea what next week is going to bring, or even tomorrow. But I do have a good idea what I think the long-term 10, 5 years are going to look like in general, just based on history. And that's something I think Better Investing has showed you pretty much over the years. Now, this is that fabled Excel spreadsheet I've shown you, or I mentioned several times now. There's some key things in here for you to work on, but this is pretty simple. You can take your stocks, you can put them over here, you put the cost basis in here, and depending on the formula that you use in here, which is built into the Excel spreadsheet, it will then calculate, what your target price is, et cetera, et cetera, et cetera. So I'm going to click on a few boxes. So here's the dates I've owned stock, and these are real stocks from one of my portfolios, and this was done a couple years ago, 21. So here's stocks from 2008. We had held that long, so that's 13, 14 years. Something from 97, 2 stocks, 88. So we've had stocks for a long, long time. So that's just to let you know that we do own stocks for a long time. And of all those stocks, I own all those still except for ATVI because they got acquired by Microsoft. This one stock never had a trimming event, even though the stock's up 430% from our cost. Why? Its position size is too small. We have a formula in here that does all that work for us. Here's the formula, 2x that average weight. So the average weight is 5.3% based on the whole portfolio. I'm just giving you a subsection of the portfolio. 11% would be the weight. So anything over 11, we should be considering trimming. We have a target price. Now the target price is that 60% that I told you over cost, or if we've trimmed it several times, it's 1.6 times whatever your cost is times how many times you trimmed it. It's a pretty simple process if cost is your basic issue. Now, there is problems with doing that, and I don't want to get too complicated. If someone wants in Q&A, we can go into more details on that. But there are other things you can do. You can use the most recent cost. You can use what your sell range is going to be in your stock selection guide. You can do many different things here. I just do it over cost. Why? Because it's easy, it's mechanical. I don't have to do a lot more work after that. I have a spreadsheet that creates an if-then formula. It tells me, no, it's not ready to be trimmed. Maybe, which usually means that it's met the gain return over 60% since the last time we sold some, but it's too small in the portfolio. Or in this case, yes, Schwab should have profits taken from it. And so this is it's an Excel spreadsheet, fairly simple to use. I think we're going to share that with the group. I don't remember exactly, but if not, you can always email me and I can send it out to you. And I haven't had too many issues other than people do ask questions occasionally about this or that, the next thing. So it's formula driven. This is the formula. It's just a simple if-then formula. It throws different things in there, but it's again looking at time, looking at definition of a target price. In this case, it's cost plus 60%. If you want to do something different, then it's cost plus 100% or whatever it is you want to use. Second, again, this portfolio is looking at 2x the average weight. So I'm looking for large sizes in my portfolios to do something with. Small positions, you must pull that on your own to make a decision. Well, should we trim some of that now? Because it hasn't gotten big enough in your portfolio to automatically get kicked out by the system. Remember, tiny positions don't impact your performance nearly as much as large positions do. And so that's some reason we try to control the large positions. Like I said earlier, you can control in the you can incorporate SSG, that sell range, as part of your sell price if you want to do that instead of using 60% over cost. The problem that when you do that, you have to update the spreadsheet on a regular basis as you update your SSGs. Okay, here's an example from one of my clubs. Here's our There's our 3 trims, 4 trims, 5 trims. I have not updated because I didn't have enough time, unfortunately. We've had 2 more trims since then for another $16,000 in gain. And then back here, we did a distribution of 70% of the stock to the club members at that time. And in hindsight, we trimmed a total amount of $23,000. We distributed $78,000. Again, we only invested originally $11,000 in this, so right there's $110,000, and we still had at that time $69,000 in the stock. Like I said, we've done 2 more trims since then for another $16,000, and we still have $86,000 still left in Apple. Apple's been the stock that's been a very giving stock to us in our portfolio, and I think many clubs who've owned Apple will say the same thing. It's been a great stock to have had and held in the portfolio. But as I said earlier, if we had sold the whole thing here, well, we would have missed out of that. However, if we did sell some, so that means we did miss out on all this other gain. We sold some, we missed out on all this. That's part of the game. That's part of the process. It's just, you got to accept something. You're going to give up something at the end of the day. But this has been obviously one of the better examples, but it's not the only one. We have many others that have done fairly well over time. Leaders do not stay on top of forever. So this is the one thing you do have to worry about with trimming, is at some point you probably will need to get rid of this company. Here's 2 books that I have used quite a bit. Pat Dorsey is the brains behind the whole economic moat concept coming to Morningstar. He worked there for a number of years. He went off, started his own firm after that, following the same concept, economic moats. And this is a buddy of mine who wrote this book on Peter Lynch, John Templeton, and Warren Buffett, all 3 people who really focused their time, more so John Templeton, Warren Buffett, on finding economic moats over time. But these are good books if you want to look and read and learn more. Again, bottom line, we're trying to manage risk. That's our goal at the end of the day. Theories of concepts I use every day: letting my winners run, let them go. Don't get in the way of profits if you can. Weed your garden, get rid of your losers. Get used to getting rid of losers. It's not a bad thing at the end of the day. So over time, my capital gain and loss report has changed. In the old days, I would have some big capital gains where we sold out of whole position, offset maybe some big losses. Who knows? Nowadays, I have lots of losses I take every year, offsetting trimmings that are usually pretty good capital gains that have had stocks for a very long period of time. So it's just a different capital gain report. I spend my time worrying about the focus on the strength of the economic moat. I find the SSG sections 1 and 2 are very good at analyzing economic moats. I can see the data there very clearly when I'm looking at companies, and hence I really use the SSG to really help me become more convinced in that the strength of that economic moat over time. So I did this. Found this over a few years ago, and I thought this was kind of interesting. If you look at this whole page, this is going back about 60 years. The stock that had been on this sheet the longest, the most number of decades, in hindsight makes a lot of sense when you think about how the world is constructed. But today everyone thinks Apple, Amazon, Microsoft. Well, most of these companies haven't been around all that long. But the company that's been around the longest is a company called Exxon. Actually, I missed a scroll. It should be there. It was all 40 years until 2010. Why? It was a producer of energy. Well, our country was run by energy, and it's becoming less run by energy and now run more by technology. So the future is going to change. So Exxon might have been a great stock to have held for 20 or 30 years of this time period, but maybe not forever. So maybe the future is more Microsoft. They've only been around for 3 decades. As one of the top companies in the market. Apple, only 2 decades. Walmart was in there for a little bit, and now they're gone again. Why? The internet probably came along and probably had some impact on what they're doing. IBM was big way back when, but not so much anymore. Oh, there's that Exxon. I don't know why it came in late. But anyways, bottom line from that chart, from my perspective, is companies don't stay on top forever. You need to eventually move on. And it's usually what's going on in the big picture of the world. And the reality is energy did drive our country for so long. We're slowly, but I think, shifting to other ways of thinking about energy. Technology is probably what is going to drive our country going forward. So selling is tough. Trimming should help you let your winners run. Control your position size. This has helped me hold on some really great long-term winners for long periods of time. Sell when you think the future is poor. Get used to selling, guys. There's nothing wrong with selling a loser. You just move on. It's not a big deal. Trimming doesn't always identify when you want to sell, like an SSG would do. I mean, your SSG will tell you now's the time to sell. Trimming doesn't do that. It just says, oh, now's the time mechanically that you should consider trimming. You might, in that trimming process, decide I'm going to sell. We have done that on an occasion, not very often, but we have. So, but trimming doesn't necessarily identify you should sell this stock today because it's expensive. Finally, wide economic moats or quality SSG stocks are the things that I drive my portfolio more than anything else at the end of the day. With that, I'll stop. I hope I didn't go over too long, but I would welcome a chance to answer any questions you might have. And this is my email address. And are there any questions?
We have a couple questions, Craig.
Yep.
One is, and this probably would have been really relevant at the moment that you were saying it, but what size moat does ISRG have?
ISRG?
Yeah.
It's a wide moat stock, and Intuitive Surgical's wide moat stock.
And
It
there's
also,
another
it also trades up between 70 and 90 PE on a fairly regular basis. It does get down in the 40s on occasion. It's something we've owned in the model club for many years. I've owned personally for about 20 years now. But yeah, it's not a cheap stock, so you have to pick your time. Usually when the markets are going horribly bad, it gets beaten up because everyone beats it up. Everything gets beaten up, and eventually it gets down to about 40 times PE. The fact is, for 20 years now, I've been waiting for a competitor to come in the marketplace, and so far I believe there's only two, one international company, one domestic company, and the domestic company really hasn't figured out how to really grow that product line. So to me, it's amazing that this is, for most hospitals, if you want to do robotic surgery, this is the only tool that you can get. There is one other company, I think it's Medtronic, that has the other product. It's Medtronic. And they haven't sold a lot as far as I can tell. But anyways.
Excellent, thanks. And then there's a question, can we estimate the moat size of a company if there is no Morningstar rating for it?
I have tried, I have failed. But yes, so if I was doing a different presentation on economic moats, I would show you a slide of an SSG of section 2, and you can see what I think you can see. If you go compare a Visa, go compare Intuitive Surgical, go compare a lot of other wide moat stocks to a no moat or a narrow moat stock, the pre-tax profit dollars are much different. The return on equity is much different. They're both significantly higher than a no moat or a narrow moat stock. More so versus a no moat. Let's be clear. The wide and narrow moat performance differential is not all that different. Okay, I mean, let's be clear. It's not. It's 11% versus 9, which is 2 percentage points over 10 years. That's a decent difference. But the reason I gravitate towards wide moats because there's only 200 companies. There's not that many of them. So if you get rid of a wide moat stock, you're getting rid of someone that has a sustainable competitive advantage as determined by Morningstar and others that says that this company has some sort of advantage. And then you got to find someone else that's going to do better than them over time. And yes, it can happen. I mean, I don't know Boeing per se, but I'm assuming Boeing's a wide moat stock. And yes, at some point, that stock has really had some issues because they have doors falling off their planes and other things that are happening. But those would say maybe there's some other issues going on inside the company. But reality is there's only a couple of people that make planes in this whole world. They have an advantage versus others, assuming they can do it right. And so sometimes, yeah, you got to move on and say, it's not working for whatever reason. So I have done with some smaller stocks, and the one I picked or have done so far that I still believe it has an economic moat, but management really screwed it up in the last 12 months by buying a small business that had nothing to do with their existing business. And so that company is Fox Factory, FOXF. They make parts for bikes in regards to suspensions. They also sell parts to automotive industry for suspension on vehicles and ATVs and all that kind of stuff. I think they dominate their particular product. Why they went out and bought aluminum bat company, I can't really explain. Management can't really explain it to me. But if you look at their margins, they have pretty good long-term margins. But because of what they did, stock has been punished quite a bit, and the stock is down probably 50–60% from its high, more recent high. And sales look horrible right now because I think it's tied to the automotive business. I didn't realize it was as big as it is inside their product, but maybe it is. That one hasn't worked out, but you can see a wide moat company, I think, by just take 4 or 5 wide moat stocks, compare them versus a no moat stock. The margins, the ROEs are just so much better for a wide moat stock. Visa is by far the most profitable company in the world, as far as I can tell. And so it's just, it's pretty visible on an SSG.
And this is, and Sriram, maybe we answered this question, but is there a way that you can show us how to estimate moats? And I think it means using SSG pages 1 and 2.
I use Morningstar quite a bit. I'm probably in Morningstar's database every day, looking at what they have on our ratings, what they're writing about their companies. Because in their particular case, they cover 1,500 stocks, so by definition, they're going to favor larger companies. Let's be clear, most investment clubs I visit tend to have larger companies, even though we want and try to strive to find smaller companies. Most clubs I run into typically have a good chunk of their portfolio in larger companies. So there's a decent overlap between the two. But they only cover 1,500 companies. So at the end of the day, they can only go down so far. I utilize their service. If they tell me a wide moat stock, I'm probably going to believe it's a wide moat stock. I'm not going to go spend much more time on that. I want a wider narrow moat. Like I said, I probably will not. That's not true. I did buy one, what I would say, no moat company, because I believe it has store growth for the next 20 years. And if it has that, then I think I'll make my money there. But besides that company, I probably won't buy a whole lot of no moat companies unless I think they're really, really cheap and there's some catalyst that's going to make it get better very quickly. And to me, it's a trading vehicle at the end of the day. So I don't know if I'm answering your question on how to do that, but I literally will go to Morningstar and say, do they tell me it's a wide moat stock? I'm not going to argue with them. So.
Hey, Craig, this is Sriram. I'm sorry,
Yep.
I asked the question.
Sure.
No, you mentioned that on the SSG section 2,
Yep.
you'll be able to look at that and estimate the moat. I was wondering if I mean, I know you mentioned the ROE. What else do we need to look for?
The pre-tax profit. So your two margin measures, the ROE and your pre-tax profit margins, will be higher for a wide moat stock more often than not than a narrow moat stock, and both of them will be significantly higher than a no moat stock. So if I come across a company that has a pre-tax profit margin of under 10%, I'm probably not going to waste my time going any further. Now, I am tossing away companies that are fine companies. Trust me, I understand that completely. I just don't want to spend my time looking at them. There are plenty of companies that make less than 10% margins that do very well. I have one example of a company that I have owned and I still own and will probably own forever because I think it's the best retailer in the world, and I think it's one of the few that gets an economic moat, and that's Costco, and their margins are probably about 3.5%. Why? Because it's the only retailer in the world that I know of outside of Amazon now, which charges you to get in the door, and you got to pay money to get in the door to go shop there. There's not a whole lot of other retailers that do that. It really changed how retailing and really put retailing up on its head and from a different perspective. But outside of that company and I think it's more because of how they run their business more than anything. Most wide moat companies will have much better pre-tax profit margins as well as much better ROEs than a no moat company. So is that clear?
Yep, thank you.
Okay.
Thanks, Huron, for clarifying your question. And we have a comment on slide 23.
Okay.
I agree that technology will be one of the big drivers. However, looking at AI, there will be
23.
a massive need for energy to drive all the data centers. Great
Yes.
presentation. Thanks.
I agree. I think utilities are a very interesting place to be. As rates have been going up over the last 2 years, I've been adding utilities, and they don't typically get wide moat status because any other utility can kind of compete with any other utility, though they are usually geographically separate. So you have that advantage to you. But yeah, I firmly believe if it's a chicken's way to play AI is to own utility stocks. Plus, I also looked at it as the easy. Yeah, if interest rates ever were to come back down again, they should be a big beneficiary of that world. And so, yes, I've been a fairly large purchaser of utility stocks. So I would agree with that thesis.
Now the question, does Morningstar have a list of large moat stocks?
It would depend. Yes, they make it available. There's also, and since I cut this presentation short from what I had in the past, there's an ETF that people can go look at, and you can go look at their top 10 holdings. And it's called, very originally, MOAT, M-O-A-T is their symbol. And the concept is very simple. They own wide moat stocks that are priced cheaply versus what they think the fair value for the company is, meaning that the stock price is way under where what they think the fair value of that company should be. So there's some problems with how they construct that index, but you can go look at their 75 stocks. They rebalance it twice a year. And I'm pretty sure that's how. I think they only do it twice a year. But I use it to go look at names. Is there someone on that top 10 list that maybe I should take an interest in? Usually those companies are having some issues, and so maybe you got to be careful about that. Otherwise, why would you be so cheap? But that theory has worked pretty well performance-wise for the last 10 to 15 to 20 years. It hasn't worked as well in the last couple of years because of the Magnificent Seven has kind of dominated performance. The Microsofts, the Amazons, the Apples, those things have really dominated the world and might dominate the world in the future. But the concept has still continued to generally work pretty well. I don't know exactly. I mean, I go into the San Francisco Main Library and I go to Moats from that perspective, or I should say I go to Morningstar from that perspective. I go online and go get the largest holdings or all their holdings for the ETF MOAT, MOAT. I think that's a great way to go look at some ideas, and maybe there's something very interesting in there. They have some stocks I've looked at. I think Polaris is one of them that I've looked at. I just haven't gone and done anything with it because I think there's some other issues with the company and the business. But there's things in there that you can go and look at that say, hey, maybe this one's an interesting one.
Excellent, thank you. Helen is saying that you're muted, but you're not muted. We can hear you, so I don't know, Helen, what's going on with that.
Can't help you.
Yep. And then I have a question for Joanne, because you did give us the Excel spreadsheet ahead of time. And I just was wondering if Joanne can pop in and just let us know how people can go about getting that.
Craig, there's a.
Oh, sorry, I was talking and I was muted. You can get access. This presentation will be on our online chapter website. So it's BetterInvesting/online, and under news and articles, we'll have posted this presentation along with this recording and the slides.
Excellent. Thank you. All right. I'm just seeing if there are any. Yeah, Helen, I don't know what to say. Craig is not muted, so.
So I would like to share one last comment while you see if there's any other questions out there. So I've been a financial person for the last 45 years. I worked at a mutual fund company, did analytical work for all my life on analyzing companies. So when I came across a study in 2018 that was looking at economic, number one, how they were looking at companies was very much how I had been trained years ago. And so it was very easy for me to go to economic models. But I think for the financial community, it's was one of the most important things I've seen in my lifetime for financial people to think about how you value companies, how you think about companies. And I think it dovetails very strongly in how we think about stocks from the stock selection guide and thinking about SSGs and looking at section 1, is it a growth company? Number 2, section 2, is it a profitable company? Is it making good money? And so for me, the two does just really kind of dovetailed very well together. And like I said, when I read this report and I gave you one of the 2 slides, there were 2 slides in that report that were by far, I just looked at it and go, oh my gosh, this is just amazing. This is exactly what I'm looking for. And it really changed how I was looking at doing investing on my professional side a lot. It confirmed that what I had been taught and trained as was the right way of doing it, because this was a very similar approach. But the nice thing that Morningstar did was they made a complete process and put it all together and codified the whole thing so that everything is the same between company to company to company. And that's what makes it so valuable from my perspective. And so, it's been an amazing, it doesn't work perfectly all the time. No, let's be clear, nothing ever does. But I have found it's been very, very useful for me to continue to be able to hold good quality companies for very long time periods, take some money off the table, knowing that if I still believe it's a wide economic company in the future, then I have pretty high confidence that it will probably continue winning in the future as it has in the past. So anyways, that's my beliefs. Anything else?
All right, excellent. Thanks, Craig. We have a question again about how to get the spreadsheet and the slides. So I'm going to put the link in the chat. And if you can just copy that, I'm assuming they're not there yet, but now that the presentation's over, we should have them up there by tomorrow. Is that correct, Joanne?
It depends, because I can submit it. Depends when it gets approved. So.
Oh, I see.
When I get it, and then it'll be up there at least by Wednesday.
Excellent, thank you.
And then I found on the Morningstar indexes, if you search for Morningstar wide moat focus, they have a CSV file that you can download that lists all their wide moat focus companies. You want me to put that link in the chat? I can put that link in the chat.
Sure.
Okay. And then Dan Perlman had, using this system, do your number of holdings tend to grow? Do you have practices to manage number of holdings?
Good question. So it does tend to make your portfolio grow a little bit in size, and it does one other thing that you have to think about particularly when you're doing your reports on your SSGs. So I'll pick on Intuitive Surgical again, because that's like Apple. It's been the stock that continues to give and give and give. Because the stock has done well, we have trimmed it, but it's still a big weight in our portfolio, but the stock's done well. So when you do your SSG at the end of the quarter after your earnings, you look at it and you go, well, the upside is very limited. Might be a 5% return upside. And so that does beg the question, maybe you should sell the whole thing. And that becomes the question: do you sell the whole thing or just trim it and want to hold that big company? I've given you my argument why I want to hold it for a long period of time. You're free to move on and go find another stock. And so what it does do performance wise is you can start looking, if you do the PERT, you'll start seeing, well, some of the portfolio doesn't really have very much upside potential. And that part is true. I'm not going to argue against that, but I think it's worth still owning those companies for the long run, unless you fundamentally think there's a problem with their business, because I think you'll get a better return over time. Having said that, you know, time does tell whether it's true or not. And the other part is you can't measure is, if I get rid of that stock and I buy XYZ, you know, is that other stock as good or not? And that's the biggest issue. But yes, we end up having position sizes. There is some creep that goes on. But reality is that's why we end up trimming a lot of losers. So we'll or not trimming, selling our losers. So when we see our capital gains at the end of the year, we'll have 2 or 3 trims, if not more, for our portfolio, and then we'll have 2 or 3 stocks that we've given up on. We've had them for a year, 2, 3 years, or fundamentally it hasn't worked out the way we originally thought it was going to work out. And so we're constantly trying to find that next great stock in the portfolio. And so we are probably, sometimes we're a little bit too patient with some of the stocks, but you know, it ends up growing. The portfolio does grow a little bit over time, but you do control it by just getting rid of the losers. On the other hand, the other thing it does do, I will tell you, is your portfolio doesn't change dramatically over time. You know, if I go back and look at the portfolio 10 years ago or 5 years ago for a lot of some of my clubs that have done this, you know, those top 5 stocks are pretty much the same top 5 stocks that were back then. And, you know, so one of the risks is the whole market could shift away from what you've been invested into, i.e., let's say if it's technology, you know, the market shifts away from that for a period of time, and that can hurt performance wise. And that's something we'd have to address at some point. And who knows, maybe we're at that point now where technology is going to shift into some other asset class does it much better. I don't know. But we'll see. We'll talk about it, I'm sure, at the next club meeting. But it's a good question. It's a that you do end up getting more stocks a little bit, but like I said, we just end up selling the ones that just aren't producing what we think is the right thing. And then eventually we do sell our stocks that have done really, really well, where we think the end is, some point in the future is going to be not as good as the past.
Excellent.
Anything else?
Any final questions for Craig?
I hope it's been useful.
It's been excellent.
I
Fantastic
thoroughly
presentation.
enjoy trimming. I think it's a very interesting way. I do want to ask, do other clubs do trimming? Do you people, I mean, is this a new concept to you, an old concept? Because that's the part I'm trying to understand. Is it new? Is it widely used out there already, or not?
No, the 2 clubs I belong to, we periodically do trim.
Okay.
I think for
Like,
us, when we started our club, you know, we had this idea that we had to either, you know, it was an all or nothing. And it was almost
correct.
like a crazy revelation when we said, oh, we could sell part of this, you know, I think. So it was kind of a fun realization, and it was liberating when we realized, or, you know, it sounds silly, but when we kind of thought to ourselves, oh, we don't actually have to do everything. We could do just, you know, trim. And that kind of opened up a lot more, like you say, boldness and a little bit of liberation.
It was. And like I said, when I first taught this class at the national level, I got the biggest response I've ever gotten from a class I've taught at the national level. And so I knew I was hitting on something useful. And so I just keep on trying to spread the word, because I think there's a lot of people that still live in the world of, I buy it, I sell it. I buy it, I sell it. And I go, well, there's something else you can do with it. So anyways, and then tying in that with wide moats, I think has been very important from my perspective. So.
Thank you, Craig. My club does use trimming, and mostly we learned to do that after we watched one of our stocks just kind of, get outsized, and we thought we were kind of geniuses. It was 10 times, what we purchased it at, and we watched it come all the way back down to 0. So after that, we decided that we would trim and not be such pigs. But you did give a really nice methodology about, how, over 2 times the average and a gain of 60%. So you kind of put, like a metric onto it that just makes it a little bit more, without thinking, right? Not negotiating. If you've agreed for that, maybe that's where you are.
Yeah, no, it's like I said, it has changed the conversation in my club meetings. It's no longer, are we going to sell the stock, or why are we going to sell at this time? It's, well, the system says sell, so we should sell, right, guys? How much? And secretary in the group just basically says, how much are we going to sell? He doesn't even ask, are we going to sell? It's how much are we going to sell? And so it just changes the conversation a little bit. And I think it also demystifies selling as a problem, particularly when you've sold some and then watched the stock do very well afterwards, and you had the majority of your money continue to do well. Or the opposite, was you've sold something at a very high price and then it collapses afterwards, and you go, well, at least I'm glad. And I have examples of that. DocuSign is a great example of a stock we owned that went up 5-fold in about 2 years, and we trimmed it 3 or 4 times, and glad we trimmed it. We got all our money out and more, and now the stock has fallen back to earth again. And some of us are still trying to decide if we're going to keep owning this thing or not. So it has worked both for stocks that have done well and stocks that did well on a temporary time period. So,
in response to your question about trimming, Craig, we've had a couple of people respond that they either know of clubs that trim, or that they trim themselves, but they can't seem to get their club to trim.
yeah, it's a discussion. To be honest, I have not been able to get the San Francisco Model Club to adopt it as a formal process yet. I'll keep trying, because we need everyone to vote on it and approve that that's what we're going to do. And not everyone wants to do that. So yeah, it hasn't happened. But in my 3 personal clubs, it's something we do on a very, very regular basis. It's part of the spreadsheets we give them at the beginning of every meeting. So. Well, I'm glad to hear that there's trimming going on out there. That's a good thing.
Thank you, Craig. This has really been wonderful. I have a pile full of notes that I took during your presentation, and I'm probably going to have my club listen to it if they haven't tuned in already. So thank you again.
Well, thanks for having me. If anyone has any questions,
I do have one.
Oh no, it's too late. You can't. No, don't. Go ahead, please.
The Excel spreadsheet, will you be able to forward that to me so I can load it to our website?
Who is this? I'm
Joanne.
sorry.
Joanne, I did send that to you.
Oh, you already sent it. Thank you. Appreciate it.
Yeah, I gave it to Chris, I think, at some point.
Yeah,
Okay.
and I sent it to Joanne. So it should be in one of the emails I sent you, Joanne. But if you don't have it, I can send it over.
Perfect.
And they can also email me at some point if they don't have it your way. They can always email me, and I will send it out to them at some point. But thank you for having me on your call. I hope it's been useful. Hope it's you learned something from this. If it's not trimming or economic moats, those are my 2 favorite topics I like to talk about all the time. But I do feel very clear that those things can be tied together with better investing in so many different ways. And so that's what I do.
Thank you again, and thank you everyone for tuning in, and have a great night. I appreciate you tuning in.
Thank you.